Hello, and welcome to another episode of the D.A.R.E podcast, which is powered by City AM. I am your founder, host, and producer, Miranda Brawn, and today we have a focus on venture capital and artificial intelligence. And we have two gurus in venture capital here with us today. I would like you to welcome Altan and Emrah to the D.A.R.E podcast. Hello, welcome.
Hello, good to be here.
Very nice to be here. Thanks for having us.
Pleasure. Why don't you introduce your full names and your organisation and what the organisation is all about?
My name is Emrah Kagitcibasi. It's a difficult one to pronounce.
That's why I got you to introduce yourself.
I know. I've been called Ketchup Chibata. I've been called Kobayashi. I've been called very many different things. But anyway, and our fund is called Sarus Select Capital. My partner, Altan Alpay, and I have been working together since 2021. And we are investors into early stage business to business technology firms in the UK, in Europe, and with a bit of a specialist focus in Turkey, because we're both Turkish and we have a footprint there.
I love that. And your organisation is called Sarus Select Capital.
That's right.
Okay.
And we're in the process of launching our first fund, which will probably be called Sarus 1.
Not very imaginative.
Not very imaginative, but it keeps it brief. And we're working on that. And until now, we have been making single investment special purpose vehicles. And we started that in 2021. But we know each other for a very, very long time. In fact, this is the second time we're working together. But we have to go back to the previous century for our first experience together.
Well, let's talk about that, because you both were, you grew up in Turkey together, you studied together, you worked together, you've got an auditing background, then investment banking background, and it transpires that we worked at JP Morgan at the same time in the 1990s. Yes, I am that old.
Well, it's hard to tell, but I think we've seen what the world was like before 2008, and it's been huge change, and we've sort of adapted to the changing times, and in fact that's how we started on this new path.
Yes,
because both of us come from banking backgrounds, banks, hedge funds, investment management, so a fairly narrow description of a career, and then all of a sudden abrupt change in 2020, 2021.
Yeah. So let's go all the way back to the beginning. Let's start in your childhood days. You were both born and raised in Turkey.
We were.
Indeed.
What was childhood like? What was it like growing up in Turkey?
Well, I grew up in Istanbul. Istanbul is a warm place, and at the time it was much more empty than it is now. And I had a good childhood overall, really. The only issues, it was like marred by political chaos all the time. It wasn't ever straightforward. There were like coups, and there were other economic crises. There were, as a matter of fact, after I did my undergraduate, I started working in insurance. I was a CFO of an insurance company in Turkey. But then interest rates shot up to about, I think, 4,000% overnight rate it was in 2000.
Wow.
In 2000 or 2001, that around
4,000%.
4,000%. It was like, the general manager calling me, the CEO calling me saying, you don't want to keep any of our funds in any bank that doesn't start with our name. So it was like a very weird time, an extraordinary time. And I said, I was really tired of that. It was a difficult experience, really. So I came to do a master's degree here, and then I joined Deutsche Bank. I was in the investment bank in equity derivative structuring, just as so I worked very closely with legal teams in equity derivatives.
Interesting.
And I did that for quite a long time. But as Emrah said, after 2008, the whole scene started changing. It really wasn't very conducive to using the balance sheet. Everyone had to be risk averse. The balance sheet need to come down in very different banks. So it was a constant pressure on the whole entire banking sector over the years. And I started doing asset management, and I do a lot of technology companies. I review them, listed technology companies. If I like them, I invest in them for my portfolios, for my clients. But frustration started growing up, because all these companies get really, really large before they can list themselves. So in a way, you're actually losing all the upside, because when the company is small, you can get a multiple of your return. And that was my motivation to look into what I can do in venture capital. And unbeknownst to me, Emrah was already investing actually around. So when we started talking...
it took a slightly different path.
Didn't know that Emrah was investing when you...
I didn't know he was investing in VC.
We were friends. We wouldn't talk shop all that much.
I think friends don't talk work, do they?
Exactly.
Yeah. So I had come from a slightly different angle to a similar position to Altan. I grew up in Istanbul as well. I went to school there. I did my university there. And then we met at university. I was 1 year in front of you, I think. And then we ended up working together at Ernst & Young, which was an auditing job. We worked on projects together for a few years.
And this was in Turkey?
This was in Istanbul, in Turkey. Yeah, that's right. And then I left, went to do an MBA in the US for a couple of years. I was married by then. And then after my MBA, I ended up in London. I started working at JP Morgan first for a few years, which is where we were working
without
at the
knowing,
same time.
Without knowing,
we were both there. We worked there together pretty much at the same time.
You were trading floor. I was middle office. I hadn't quite got to the trading floor yet. So
I was on the trading floor, trading FX and fixed income, first in emerging markets and then in the main markets. And then I floated around at several different hedge funds between 2002 and 2019. In the last iteration, I was managing a currency volatility strategy with another colleague of mine. We unwound that fund at the end of 2019, and I found myself effectively retired. Then I knew I didn't want to go back into being a portfolio manager in a hedge fund.
Hearing that, I sent him actually all the documents, all the company information. What do you think about this? What do you think about that? And he started working together.
Organically collaborate.
That's a nice way.
Because you're still very young, no matter how much money you make.
It's not about the money.
It isn't about the money. Once you get to a certain level,
you need to enjoy what you're doing. You need to be naturally curious if you want to be in venture capital in general, because you need to delve into it. You need to understand what the company is doing, and you don't really have that much time. Yeah. And then you need to fit it into your mental framework, and that's what we do rather well, I think. I hope.
And that's what a successful mindset is all about. But carry on.
Well, I think what we like working together. We knew we liked working together. Auditing is not the most exciting or it's not something that requires a lot of intellectual curiosity, but it requires thoroughness and it requires dedication. And we thought we enjoyed doing that together. In the brief sort of 3-year period where we worked together, even at the most boring assignment, we had a good time. So that's probably the most important box to tick if you're going to work together. And we knew have fun. We knew that chemistry was there. And we like asking questions. We like finding out about new things. We like to prod and test and stretch ideas. We're like that all the time. We're like that when we're not talking about work. It's just who we are. And it works well in venture capital. We end up looking at several hundred businesses every year, end up investing in just a few. But in every business we look at, we learn new things. Sometimes it's an entirely new industry. A couple of weeks ago, we spoke to a company, Turkish, Israeli. They are in advanced earthquake detection and prediction. We know nothing about it. It's a lot of science. We had to do some learning. We liked the company. We liked how it looked. We had to do some learning. And so we rolled up our sleeves and learned a little bit. Not the deep science, but to see what they do, whether it could work, whether it works or not, whether it can be a credible business. So that was an entire new vertical we had to adapt into. We don't know everything about it, but we now have a working knowledge.
We'll survive.
We'll survive. Exactly. We'll make an informed decision. And this happens over and over and over again. There are certain verticals we feel very close to. Fintech, we spent 25 plus years each in financial services. in different products, in different functions, in different organizations, different size organizations. So when we see a fintech business, whether it's to do with payment systems or digital currencies or some wealth management for retail distribution, we know what it's about. We can pretty much guess what the success factors need to be, what the difficulties are going to be. So we have a much easier time assessing those businesses. And that's probably about a half of what we do, things we think we know about, but a good half are things we need to learn about. So,
and how do you assess the businesses?
Well,
it's a deep question, actually.
Yeah.
In fact, before we start, why don't we give the audience an introduction into what venture capital actually is? Because not everyone's going to know.
Sure.
Our audience varies from boardroom, bankers, lawyers, people outside of the financial city industries, and also students in the classroom. So maybe give a quick intro into what venture capital is and then how you actually assess your investments.
Yeah. I mean, I don't know a proper definition or an official definition of venture capital, but venture capital firms invest in startup companies mostly. And there are a very early stage called like seed stage, and then post-seed, and then series A, B, C, D, E, F, all the way until IPO, some other company buys them. So it's a bit like handing over the bucket in a fire until it can get to the fire itself. The way the whole industry works.
Although I think they don't like it to get beyond K, because then it's like, well, what's wrong with this company?
They sort of run out of alphabet at some point.
Even at F, I'm thinking,
what's going on here?
Exactly. There are two possibilities. The company is doing really well, so they want to delay IPO. So it's not always bad news, but the other way around is, they still need some financing because the good days are ahead, and that's the one thing. I think the secret sauce to why I think we work also well together. This apart from the friendship and everything is, we all humans, including us, we have our biases and we have the tendency to decide quickly, but we can hold this back when we're together. And we even switch roles when we're deciding, arguing for and against companies. We have many criteria that we look at, but we usually go for B2B, which stands for business to business. So if you are selling an app for people, for the retail to buy, that would be a B2C business or B2B2C business, the way it works, because you're going to be selling it to Apple and then Apple will be selling it to the retail. What we like is that the clients are other businesses. So that's called B2B as a sector. And we like tech, what is called software as a service. And that is usually a software company solving a problem in a business and doing it in a way they can charge an annual fee. This is our sweet spot, so to say. Yeah.
I think we like to look for businesses that do really one thing. One way or another, improve the bottom line of their customers, either by enabling them to generate more revenues or by directly enabling them to reduce their costs. To us, if it doesn't do that, it's a non-starter because then it doesn't have marketable value. We don't like it. If we can assess how much value a product brings to its customers, we can value what that's worth. And that's our starting point. It's a very, very simple first principle. If it helps customers generate higher revenues or reduce costs, we like it. And then we look at things like, is it scalable? What is the investment cycle? What is the sales cycle? Are we investing at a period when the next growth cycle is going to take them for 3-4 years to a multiple of where they are today? Or is it going to be linear? We like things that are not linear. So we look for these kinds of characteristics. We look at the founder team. It's usually either one person or a team of 2 or 3 founders. If it's one person, has to be an incredibly strong personality, because not only has it got to be strong on the technical side, but he's got to manage a business, run a business. He's got to be a CTO and a CEO at the same time. If it's a team, we want to see how they work together, how complementary their skills are, how coachable they are, because we believe there are some VCs who just invest money and just leave it. We believe we can add value beyond the capital we introduce to a business. We have a big network. Absolutely. We make connections. We make introductions. we can help with strategy. I mean, one example, even before we made an investment, a founder was thinking of next stage of geographic expansion for her business. And she was determined that it should be Germany. She started in Turkey and she was half German. So she thought her next country ought to be Germany. At the meeting, one of our advisors is a German friend of ours. He's not an early stage tech investor. He's a very smart alternative energy investor in private equity, but he's a sensible man. We brought him into the meeting, and this was a particularly sensitive business within HR, and he cautioned the founder that GDPR and personal data requirements in Germany are probably the strictest in the world, and her business may find it difficult to break through some walls, not just regulatory, but individual perceptions. And then our suggestion to her was pick an easier target as your next market, maybe the Middle East. Turkey is a bit of a hub for the Middle East. There's a lot of experience in Turkey. They like that. There's a lot of sort of corporate centers out of Turkey who cover the MENA region, the Middle East region. We thought it would be a natural next point for her, and I think it resonated well with the founder, and she went in that direction, and she's had a very, very decent success since then. So
and probably saved her a lot of money, not trying hard in Germany.
Yeah. So I think the mentoring and the coaching, that's a key aspect when it comes to venture capital.
It is
in
an
terms
important
of what you're offering, which is great.
It can be. We think it's a part of our value add.
It's a bit like the Dragon's Den, when they're there, they're investing, and they also provide advice and guidance.
Yeah,
it's a bit longer term. Yeah. Not everything happens in 10 minutes.
I know. Well, sometimes you've got to wait, 10 years, 8 to 10 years before
once the investment
is ready?
Yeah. The investment cycle is usually a couple of months.
Yeah.
But then, depending on the stage of the business, in our stages where we get involved, it's sort of pre-Series A to Series A, which kind of usually means the company knows what the product is. There are some customers, there's some revenues, maybe a second, third year of revenue stream, revenues of maybe $1 or $2 million a year, sort of rate. After that stage, probably a good 6-7 years, if not more. Yeah. If the company is particularly successful, there could be an earlier trade sale. And of course, as many times it happens, the company may fold within a few years. And that's just a natural part of what we do. There's a certain survival rate in Series A stage businesses. It's around 20 to 30% survive.
And it's like with all new businesses. But it's funny, though, because with venture capital, you mentioned Apple, LinkedIn, Uber. These are organizations that used venture capital funds to help them become the success that they are today. Yeah. So venture capital is a key component when it comes to funding and financing. But let's talk about AI.
Sure. Let's talk about
artificial intelligence.
Yeah. Yes.
It's transforming the investing world. And when you look at AI in VC, that's also when it comes to the automation of the deal process, AI is playing a key factor. If you look at the US market, VC investments in AI totaled $290 billion over the last 5 years. And there are suggestions to the fact that when you look at the annual GDP growth rate, it's going to grow by 0.5 to 1.5% over the next decade. When you put that in monetary terms, that's $1.2 trillion to $3.8 trillion in real terms. I mean, the United States always follow in terms of what the US are doing. So where do you see AI playing in the field of venture capital?
Well, I think we look at it from two angles. One is, how is AI impacting the business of venture capital? Yeah. And the second one is, what are the investment opportunities for venture capital firms within AI? And the way AI is impacting VC is, yes, it's a very strong assistant to the business flow. We use it. I mean, we're a very small outfit. We use large language models during our process. We have started using it. We are using more of it. We use AI assistants to take notes and make summaries of our meetings. We have tons of meetings. we can't make well, we used to, but now we don't have to make notes of those. We have help. It's a very powerful assistant. It's not perfect. It has a lot of room to improve, but there are more and more specific use cases. We know of VC firms who use AI to deal source for them. Use public and private databases. Basically, you introduce the investment criteria, and they will go and troll and bring back lists of target companies that fit the criteria. Whether it's perfect or not, I'm not sure. It won't be perfect, but it does help. It can help carry some of the workload.
And thinking about where AI is today, I mean, in 5 to 10 years, it will become a general partner itself. It looks like, because it's just getting better. This is so to say, the floor. This is the worst possible service we're getting from AI, because this is this year's model. In the next year's models, it will be even better. So we think it will increase everyone's efficiency, much more productivity and efficiency.
Definitely. And it's not just from a business perspective, but also from a personal perspective.
Sure.
Just even drafting an email.
Exactly.
Very basic things.
Yeah, although it does come with complications. There's data governance. AI is a data devourer.
Devourer is
it
the right
needs
word.
data to train. Whose data are we training the AI models on? Right? Lots of companies are building their own AI models. It needs billions of data points. And whose data is that? Who gives access to the data? Who has access to manipulate the AI? So there are lots of intricacies. And I think along with the growth in AI, both the ethics of AI and governance of AI are going to be very, very topical, both in terms of regulation, but also corporate standards wise as well. Any sort of established institution relying heavily on AI will have to deal with these issues to make sure that unintended consequences are kept to a minimum. There will be always, as with any new technology, there will be slip-ups, there will be mistakes, but because it's such a data-heavy and sort of self-running system with very little human intervention, checks and balances need to be kept to a certain standard. So there are very many areas where the infrastructure has to be very strong, I think, in the next 5 to 10 years.
As long as we don't give the nuclear codes to them, I think we'll be fine. That's the key.
I think you're totally right. I think the governance, the regulatory aspect, that's going to be key. But I think diversity will play a key factor in this as well. And it's funny because about 6 years ago, I flew out to Paris. No, I didn't. I got the Eurostar. Got the Eurostar to Paris. Yeah.
Okay.
It's better for the environment, for the sustainability. And I was one of the first females to talk at a technology festival on diversity in AI.
Okay.
And there is definitely challenges when it comes to artificial intelligence and focusing that on potentially a particular race and not focusing on people of colour, whether it's not just within the corporate space, but also within other spaces, whether it's health. There's so many different industries. But what I would love to do is get your viewpoint in terms of diversity in venture capital. It's still very much a male-dominated environment. We do have some key female leaders who are general partners and founders within the venture capital space. But when you look overall, it's still very much male-dominated. What more do you think we could be doing or you could be doing to help to diversify the venture capital space?
I think diversity has, of course, many angles. And just before your question, maybe within AI, the AI kind of like gets trained on the data it gets. So if the data is generated by, 50-year-old males who has worked in banking.
If the data's biased,
yes.
the
it is
machine
going
is
to,
going to be biased.
what comes in, what comes out. So
That's a good point.
It's a tricky one. You might want to, slice and dice the data set for that to make sure, a certain subset of the data set is represented one way or another. But this is part of the work, the data governance, the data work. I think exactly falls into that place, and it needs to be done because otherwise you're not going to get what you want. It's just a few formula really at the end of the day. It's mathematical formulas. Let's face it. So
it's a workhorse. So You have to make sure it's built the right way. And in terms of diversity and women founders and women professionals in VC, you're right. It's a male-dominated area, just like banking. Well, maybe used to be.
Yeah.
Maybe used to be.
Maybe
less so.
It is getting better.
Yeah, and probably VC has to follow in that. I think venture capital has historically been not the right place for many young people to start their careers, because it requires a certain amount of maturity and experience from the beginning. And also, when you think of large international banks, they can be fantastic schools, whereas a venture capital firm maybe doesn't have the resources to take and train young people. But that's changing. So I think that's going to be one factor that improves the ratios in the right direction. Another factor, well, at least in tech, most of the founders are engineers or technical background people. Even if they're not engineers, they're scientists of some kind. And historically, STEM subjects at universities are also male-dominated. So it's not a problem of adverse selection in VC. It's just the founders and people with tech backgrounds who go into VC come from the right background university experience, which is, again, male-dominated. So actually the problem, in fact, starts before venture capital. It starts with universities. So sciences and STEM subjects increase their women intake. I think the inflow of women founders and women VC professionals will also increase. But I think we are seeing already more and more and more interest from women into the field, at least into the VC side.
Definitely. And I've got a charity that I also launched nearly 10 years ago. Next year it'll be 10 years. The Miranda Brawn Diversity Leadership Foundation. And that's to help increase the next generation of diverse leaders across all different sectors, which includes STEM, which includes finance. So I think having organizations like that, because we need to improve the pipeline.
Exactly.
I think when we improve the pipeline with organizations like my foundation, that will help. But I think when you've got, right now, we do have a lot of good people in finance who potentially could join a venture capital.
Sure.
Yeah.
So the talent is there.
Yeah.
So I think sometimes
I think in the VC world there are two types of founders, the VC managers, I mean, right? Not founders of the companies we invest, but the VC companies. Yeah. And some of them have done a successful exit before, so they are like previous founders, and they become VC managers themselves.
That's right.
And I think that's a great source to get diversity, females, or I don't know, other races and everything. You can get a lot of diversity out of that.
That's right.
And the other ones are like ex-finance people like us, a little more boring, but they're at least careful with their clients' money, hopefully. So and there are quite a few. Minority presence there, but there isn't much that are going into the VC world, because my thinking is people have this the view of VC, and some of them are they don't enjoy it very much because it's quite uncertain. It's a bit like I always liken it to the 1860s, gold rush for San Francisco, where you're looking for a lot of companies to find that little gold tiny nugget. And a lot of mud they were going through to find that gold nugget. And whether that's enjoyable or not as nature, I don't know. But personally, we think we like investing by consensus. So if one of us gives a 4 out of 10, it's not going to go with all our GPs, actually. We're 3 GPs, and having more diverse views actually helps the performance of the VC. That's so important. And we would love to get a female VC on board at some point in time, for sure. So anybody listens to this, they should make an application, send us an email.
Absolutely.
Well, watch this space, you never know.
Yeah, exactly.
But I think also when you look at the VC, it's interesting with the actual origins, because in the UK, most of the VC founders tend to come from that investment banking, that financial background, whereas in the US they tend to be more entrepreneurial.
Yeah,
so that's
exactly.
quite interesting, the different elements of that. But what I'd love to do is focus on what's the best and worst advice that you've had.
I think the best advice I had was from my father. He wasn't a very overbearing parent, but he gave me one good advice, and I was a bit of a slacker at school, and this is before university, and I wasn't headed in the right direction. But I think he felt that if he steered me the right way, there was enough time to change course. And he took me aside one day and he said, "Look, there are a number of good universities in this town. If you go to one of those, you're always going to have an easier life than if you don't. And if you like nice things in life and if you have goals in life, it would be good if you had an easy life, because those goals aren't going to come easy." So that was a very, very good piece of advice.
And how old were you when you just get that?
17.
17 is a good age. So it wasn't dismissed.
Yeah.
17. Bad advice? Oh, maybe I tend to forget about bad advices. I don't know. Bad advice.
Bad advice, I can give an example,
yes.
Macy.
There you go. You come
and
with the bad advice.
It will somewhat conflict the D.A.R.E podcast name. But, going after your dreams, Emrah just said 50% of these companies fail. At seed stages, it's even higher. Quite a few of them fail. And going after your dreams at all costs, going for it full whammy, it isn't right? What you want to do is you need to recognize what traders call a stop loss. You need to recognize that it is an insurmountable challenge. If it's a hill and you can get over it, great. But if it's a mountain, you need to recognize when a mountain is a mountain and you need to stop there. And so I don't want you to dare at all costs. I need you to be a sensible dare, if you know what I mean, or if you kind of understand what I'm trying to say.
Yes.
It's a bit, So
caution.
Yeah, caution is always,
But it's also, the R stands for risk. You've got to take a calculated risk in anything that you do. Yeah. So what's next for you, personally or professionally?
Well, professionally, we're working on a project.
The new fund.
So, we're launching a new fund. So we've been doing this for a number of years now. And we have some indication from a few sort of key parties that they would like to see a fund. So the difference is what we've been doing until now is we look at companies. When we decide to invest in a company, we set up a small vehicle that invests only in that one company. It's a passive investment vehicle, and our investors invest into that. Whereas with a fund, it will be a fund that will be raised for a certain amount of money, and it will be a closed-ended fund which will make 10, 15 investments over the period of a couple of years, and then it will wait out until all these investments are exited, and then it will generate a return for the investors. So it will be a managed fund, and
is it a small fund? Is it up to 100 million, up to 20 million?
It will be a small fund. As a first fund, I think no one we speak to recommends over 20, 25 million. And in fact, we get it. When we look at the numbers, the stages we invest in, the valuation of those businesses, and the average funding round they usually do is a certain size. And we want to keep the fund to a size that's suitable for those tickets to make 10 to 15 investments in a period of around 18 months. Mm-hmm. Anything bigger, we either have to extend the investment period or increase our ticket size or increase the number of deals we invest in. We don't want to increase the number of deals we invest in because we know our capacity. It would mean not doing enough work for each investment.
And
we don't want to compromise on that.
We really want to go for the best ideas that we get, best companies, because it's your first fund. It's performance.
So we don't want to compromise
incredibly crucial
on that.
And this is all technology focused.
This is all technology
focused.
Certain stage, certain verticals. So because we have a very clear understanding of what we want to do, it needs to be below a certain size. We think around 10 to 15 million is probably the right size for what we want to do and for the number of investments we want to make. It's going to be in B2B technology. It's going to be UK, European, a bit of a special angle with Turkish startup ecosystem. Our DNA.
Yes.
We have connections.
Take
we have contacts.
Yes.
It's our roots. We understand the country. We understand the region. We know the way business is done. And I think we mentioned this, we want to have more value added than just the capital we invest in. We're in a unique position to provide certain kinds of guidance for those businesses that are expanding from Turkey into mature markets. I think we would be a very good bridging role for those founders. And we normally look for founders who are coachable.
Yep.
So they particularly value our input. So that's our sort of that's our mix.
Great. And this is a successful mindset podcast, focus on leadership. So some tips include daily affirmations, which is what the A stands for. It could be visually drawing or writing down your goals. It could be vision boards. Have you ever used any successful mindset tips? Have you had a successful mindset coach? Have you done anything like that to help you achieve the success? Because you're both very successful. You've achieved success in banking and now you are striving for success within the venture capital space.
I think I can say this for both of us. We spend a lot of time making sure we're focused.
Yeah.
And I think that's probably the most important tool.
Yeah.
We have to stay focused and to keep challenging each other.
Yeah.
At least in our business, in our little unit, that's what we rely on, being focused and to keep challenging each other so that we don't rush into things, we don't overlook things, good aspects and bad aspects. We want to make sure we cover all the bases so that we don't fall into hypes. There's a lot of hypes in VC.
It's easier to raise money for hypes, right? Because everyone knows it, everyone gets excited by it. So keeping your cool about AI, about artificial intelligence is not that easy, actually.
That's right.
So it's a tricky thing.
Yes.
So focus, concentration, and striking the right balance of challenging one another.
Yeah, sounds good.
I think that's in the business. Yeah, absolutely.
Last question. It's gone so quick.
It has.
It's gone very quick. So it's called D.A.R.E. We know what the D.A.R.E. stands for, but we also ask all of our D.A.R.E. podcast guests what would you dare our audience to do? Altan, you go first.
That's a tricky one, this. Well, the one thing I think I would dare the audience to do is to actually start a habit, form a habit, because everything we just do once, I'll eat healthy tomorrow is just once that Monday, and getting into a habit is the key in many things. Now, we have a working habit order among ourselves, and all these things that Emrah mentioned, they are the habits of the business. It's a bit of nature of the business, and that's what the business really is at the end of the day. Anything else is just happens once and goes.
And it takes 21 days to form a habit.
To form a habit at the very least.
You could change your life in 21 days.
Exactly.
Omar?
I'm going to counter that just a little bit. Not exactly, but I told you this is what we do.
It's got to challenge each other.
And this isn't just for young people. This is for everyone.
Everyone, yes.
I think it's always a good idea to force oneself to leave their comfort zone. Every once in a while. Not all the time. For certain things, it's worth it. It's never easy. It requires a lot of discipline. If you're not desperate, most people won't do it. But forcing oneself to leave their comfort zone, I think, opens up all kinds of opportunities and new perspectives. And in fact, once you do it, it's always easier the second time around. So that would be my dare. Leave your comfort zone.
100%.
But not once, at least 21 times.
Yes.
All right.
Okay.
Right. I think that's so key. And you've proven that. You moved from Turkey to the UK. You went to the US to study. Yeah. You've gone from auditing at EY, now it's called, to banking, to, various fields. And now you're venture capitalists.
Yeah.
So thank you very much.
Thanks for having us.
Thank you.
But thank you very much for being a guest on the D.A.R.E. podcast, which is powered by City AM. You've been listening to the D.A.R.E. podcast, powered by City AM. I'm the host and producer, Miranda Brawn, and we have been discussing some amazing topics around venture capital and artificial intelligence. Don't hesitate to follow, subscribe to all of the usual podcast platforms. You can watch us on YouTube. And if you would like to nominate someone to be a guest or to sponsor a D.A.R.E. podcast episode, feel free to contact us at the D.A.R.E. podcast at miranda@gmail.com. We also have some questions for Ask Miranda. So if you would like any questions answered, feel free to contact us on the same email, and we will address a one-off episode called Ask Miranda to go through any of your questions. Thank you very much for listening and watching. Until the next time.